Hello, and welcome to another MyCPE Insights, a roundup of some of the top tax and accounting stories of the last few weeks. My name is Jason Dynison. You can hear me in the archives here at MyCPE One on many different tax topics, and I host these little insights that we do every couple of weeks where we recap some of the stories that have happened in the news. Now, the big beautiful bill passed and was signed into law on the 4th of July. And we've talked some here about the big beautiful bill, and you can find several webinars for continuing education credit at MyCPE One that go into great detail. There's only so much we can say on these little like 15-minute news roundups, but there are 2-hour sessions. Some of them might even be longer than that about the big beautiful bill. But here's something that we wanted to talk about because it's been on social media, and the Social Security Administration also sent something out. I bet you got it. I got it. I think they sent it to everybody that they whose email they have. And SSA said that the big beautiful bill eliminates federal income taxes on Social Security benefits for most beneficiaries. And that's something that other people have said. It eliminates Social Security from taxation. That is not true. There's parts of it that are kind of true for some people, but it's not something that's specifically tied to Social Security. The piece that's true is that the bill creates a personal exemption deduction of $6,000 for taxpayers age 65 or older. And it's available for the primary taxpayer, or if it's married filing jointly and both spouses are over age 65, it would be $6,000 each, so $12,000. It's not available for dependents. But for primary taxpayers, the people whose name is really on the return, it's $6,000 for people age 65 or older. So what the big beautiful bill did, if we think back on this, the Tax Cuts and Jobs Act eliminated the exemption deduction, or technically suspended it, from 2018 through 2025. And the big beautiful bill says that that suspension of the exemption deduction is made permanent, except for 2025 through 2028, there's a special $6,000 exemption deduction for people age 65 or older. So that part's true, that people age 65 or older who may be receiving Social Security, they get this extra deduction that's going to knock their taxable income down. But taxation of Social Security has not changed in and of itself. You're still going to calculate the taxable portion and claim that as income, but then you get this $6,000 temporary exemption deduction. Now, one of the questions that I have on that is where this $6,000 will go. I believe that it's an exemption deduction that's probably going to be in the same vicinity as itemized or standard deductions. Some people say that they think it'll be just an extra standard deduction. I don't know about that because my reading of the bill is it's a separate thing that's in the exemption section of the tax code. Whatever you call it, it's a deduction of $6,000 for people age 65 or older, but not necessarily everyone's 65 or older, because there are phase outs based on income, $150,000 for joint filers and $75,000 for everyone else. By the way, married filing separately gets 0. You can't claim this exemption deduction. So the way the math on this really works is you're going to calculate the taxable portion of Social Security the same as always. There's no change to that at all. And you'll report whatever is income in income. But later on the tax return, if the person who's age 65 or older qualifies, they'll get to deduct $6,000, but it's not really a reduction of Social Security per se. It's just a deduction. Let's move on to the next story, a couple of tax scam stories. So in Chicago, a tax preparer has pled guilty to filing fake tax returns. So there's this preparer in the Chicago area, Ada Villanueva, who did things like fabricating Schedule C business losses, inflating medical expense deductions and charitable contributions, fake dependents, misusing tax credits, education credits, earned income credit, and even had refunds routed into her account in some cases. This isn't the first story. And here's the thing, we could highlight these kind of stories almost weekly, because periodically, if you get the IRS newsletters or whatever, there's usually a compliance piece of what what they're up to in enforcement and the tax preparers who have been busted recently. So she's facing up to 3 years in prison, having to pay restitution and various penalties. The problem with her clients then, or that her clients have, is that the IRS knows who they are and might want to come after them. Now, this person, it was an unlicensed preparer, and the IRS estimates that over 50% of tax returns are filed by someone other than the taxpayer, but not all of those preparers are licensed or credentialed. And it's been a long time since the IRS tried to really do anything with changing that. It's really something that the IRS can't control. Congress is the one that's going to have to do something about it if anything is ever going to be done. But, on the slide here, what can be done? Use AI for pattern recognition. The IRS has said they're going to be employing artificial intelligence more. Now, they've said that for several years, that they're going to be using AI, or that they are using AI. They've said that, like they announced a few years ago now, that they were using AI to help them audit large partnerships. And one of the questions that I've always had is, what does that mean when you say you're using AI? How? Of course, they don't say, but anyway, employing AI, and I think the IRS has already been like flagging PTINs and saying, hey, let's take a look, kind of like in this case of this preparer from the Chicago area. This is in Phoenix. Another tax preparer was caught filing fake tax returns. So this person with the last name of Kashoshi, who owned this Africa Union Tax Services LLC. From 2021 to 2023, they took advantage of false claims for fuel credits and the Form 7202 FFCRA credit for self-employed people. Now, there was a rush of advertising around Form 7202 the FFCRA for self-employed people a few years ago now, with these places saying we can put your claim in and you qualify. I forget what the dollar amount was. It was like 33,000 or something that they said, everybody qualifies for. That, I mean, like a lot of things with the COVID credits and the places that were advertising, we can get you your money. It's like, yeah, that would be the maximum, but a lot of sole proprietors wouldn't qualify for anywhere near that amount if they qualified for anything at all. Now, this person was filing false claims. And oh, by the way, this Kashoshi conveniently forgot to report their own income in 2022 and 2023. Oops. So the Criminal Investigation Division looked into this and had some things to say. And this person actually faces prison time in a 1.3. Now, this person, this is actually a different person, a CPA in New Jersey, who faces prison time in a $1.3 billion scam. If you're a regular listener or watcher to this, you might remember that we talked about that dentist in Colorado who set up the fraudulent trusts. Now, that wasn't a CPA, that was a dentist, but there's been a lot of stuff on that, and no one is flying under the radar. And, we may have had an administration change and budget cuts and staffing cuts to the IRS, but if people are doing things like this, the IRS is going to come after them. And when the IRS catches them, they're going to have some problems. On that same front, COVID tax credit schemes. In particular, FFCRA. Now, FFCRA isn't the only one. You have PPP loans, which PPP loans really are not an IRS thing. That would be a Small Business Administration thing, but it was a COVID thing. Employee retention credit, and many false claims paid out there, and some 93 million in FFCRA claims. Now that's not overall, that's just in one scheme, 93 million. So FFCRA was a legitimate thing, and it was available to sole proprietors as well. It was available to any business, but sole proprietors could claim it too. And so there were these 3 people in Southern California who set up fake businesses and then filed fraudulent tax forms for other people, and then took a cut of 20% to 40% from each refund that was submitted. And so this is something where, according to reports, friends and family and even romantic partners got into this. So lots of money flowed in, and it was all good until the IRS started asking questions, and then the FBI. That's not good well, it's not good ever. The IRS even coming calling, but then you get the FBI checking in on things. These were fake companies. Sometimes payroll reports were submitted that there were no employees. The company didn't even really exist. Here's another tax fraud story. They just keep coming. I guess it's not necessarily tax fraud, I guess. Well, it is tax fraud, isn't it? He pleaded guilty, or was found guilty of a tax fraud scheme that led to over $1 million in losses to the government involving payroll taxes. So this guy's company had over 8 million, almost 9 million in wages paid to employees. But instead of paying in the withholdings and the payroll taxes, this guy underreported wages by over $5 million on what was filed with the IRS. And this led to W-2s that didn't match up with reality that were given to employees. And, the thing about this is, this guy was basically skimming these withholdings then. That actually affects employees because SSA records what's on the W-2. And if you're underreporting on the W-2, that affects their benefit calculation. Plus, of course, the problem of over $1 million of payroll taxes not being deposited. Payroll tax issues are a big, 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 big deal. Of all the different types of fraud, payroll tax may be the thing that the IRS is going to drop the hammer on the most. And even if it's not fraud, if you've ever dealt with a client who's simply fallen behind on their deposits, I've dealt with that a couple of times through the years. No fraud. The client they didn't make deposits and the money got spent, and it was just, they were disaster areas. And, the IRS, they don't care what the excuse is. That's trust fund. That's literally what it's called, a trust fund, because those are tax withholdings and payments that are supposed to be made on behalf of your employees. You are being entrusted with making those deposits and payments. And if you don't, the IRS is going to come after you, whether there's fraud involved or not. You might be able to get into a payment plan. Both of the ones I dealt with, they got payment plans, but the terms, it's not the usual 72 months that you get with typical payment plans. It's 36 months instead. And you also really have to keep current with your deposits. The IRS takes this very, very seriously. And yet it seems like these people get caught most of the time. I suppose some people don't get caught, but I think most people who try pulling these things, they end up getting caught in the end. Audit problems, audit report problems for one of the big four accounting firms, EY. EY has admitted that it violated US and UK audit rotation rules during its work for Shell in 2023 and 2024. By the way, EY billed $66 million to Shell, but then had to take back its audit opinions, not because the numbers were wrong, but the person signing off on the audit shouldn't have been involved in the audit because they were supposed to have been rotated out. This has actually happened before. Auditors in the UK, or regulators in the UK, fined EY £325,000. That would be like, I'm doing math in my head, probably 350,000 or thereabouts US dollars. Maybe even more than that. KPMG has also been dinged by the UK regulators for the exact same problem. Now, what are we talking about here with rotation rules? If you're not familiar with auditing rules, the SEC, and I mean, these rules apply in other countries too, but the SEC says the lead audit partner has to rotate off if it's a public company engagement, after 5 consecutive years, and similar rules exist in other countries such as the UK. So these rules help prevent the auditor from getting too close to the people at the company and maybe losing objectivity. So when these things happen, it's one of those big problems. And on the subject, it has all to do with independence. PwC and Deloitte have faced similar problems in the past with independence issues and not properly rotating staff. And, there's a lot of moving parts in these gigantic firms, so it can be easy to miss if someone's 5-year clock has expired. But the regulators, they don't care what your excuse is. If you're doing this kind of work, they feel like you should be keeping track of those things. All right, Deloitte is having problems in the United Kingdom. Now, first of all, the good news with Deloitte is that they've had some wellness perks that they've rolled out for their employees, $1,000 of perks. So their employees can get gym passes, literally Star Wars Lego sets. But as this has been going on, the regulators in the United Kingdom have launched an investigation into Deloitte and AZETS over their audit of Stenn, which is a UK fintech company that was once valued at 900 million, and they've collapsed since then. And they're being investigated over allegations of ignoring red flags, bogus receivables and transactions, and so forth. So Stenn was one of the global financial leaders and claimed that they had 10 billion in receivables. But reports show invoices from companies that denied any relationship with Stenn. And another 1.7 million were linked to sanctioned Russian entities. So Deloitte took over after EY and AZETS both stepped away. EY had flagged related party concerns back in 2018. And then the UK HSBC got involved and alleged that there were fictitious transactions. And the firm collapsed. This company collapsed in December of 2024. And now all of the fallout is coming back on the CPA firms that did the audits, with questions over why didn't they challenge the valuations or investigate certain things that were going on. So that's our roundup of some of the top stories in the tax world and the accounting world. My name is Jason Dynason. Remember, you can check out more MyCPE insights on the MyCPE website and find over 15,000 hours of continuing education content, including quite a bit of content from me. So join us again on MyCPE Insights. Thanks so much and have a great day.